Good afternoon. This is Andy Pedraza with Special Effects Academy on our bonus session on Friday, March 9th, and we're going to be looking at risk. It's going to be a brief introduction, probably not as brief as the word implies, but nonetheless, this is going to be a very superficial treatment, and the actual steps to mitigate risk, they will be dealt with individually with you guys as we create or help you create your trading plan, and as we work through the remainder of the Elite Trader program, of which this session is a key part. So the title is going to be Risk, a brief introduction, and these are the necessary things to know before trading. Risk is an unavoidable part of life and of trading. Anytime you're going to take action, you're going to be assuming risk. But more importantly, even if you're not taking action, you are also assuming risk. So risk is a part of everything. There's just no way to avoid it. It can be managed and mitigated to a certain degree. And in this case, knowledge is going to be your best friend. Knowing what's out there is going to protect you from a good portion of the risks that are out there threatening you. But you're not going to be able to protect yourself against risk that you're unaware of. So risk is always going to be divided into the known and the unknown. And normally you can protect yourself from stuff that you don't know about, or can you? We're going to look at some things in this presentation that will help mitigate some of the unknowns as well as the known. We're going to be talking about 4 different things in this introduction to risk: the known risks, the unknown risks, equity protection, and trade protection. And we're going to wrap it up at the end with a, going to call it a 5th section that's not mentioned here in the contents, but it's going to be the next steps, what's to follow from this introduction to risk. What are you going to be able to do to prevent yourself, your account, your trading, to be taking on more risk than should be allowed? The first section is known risk. This is going to be fairly easy to protect against. So it's a wonder that many traders still blow up their accounts from things that they should have been aware of and just either decided to ignore, or through some psychological factor, it just blindsided them. They may have these blind spots that if you're not working with a coach or with somebody else who knows the ropes and is assisting you, you may be totally unaware. And I'll give you some examples of that from real life and from recent history that I'm aware of to show you how that can affect you. Here are some examples of the known risks. And most of these you're already going to be aware of from the prior sessions, as well as our chats, your chats with Callum, and everything else around trading, your history, and your background. But here's a very short list. It's not meant to be exhaustive, but it does cover the main areas. Scheduled announcements. Whenever you have something like today's non-farm payroll, you know that it has the potential to move the Forex pairs to a very high degree. Volatility is going to be increased during scheduled announcements, especially if there are any surprises, if the announcement is different than what the market expected. You can, of course, protect yourself by not being in any trades prior to that announcement, or setting some very wide stops. So even if the announcement causes high volatility, if you're still convinced that you're trading in the right direction and you don't want to get out of those trades, well, you move your stops a little bit so you're not taken out by accident. So there's going to be ways to mitigate that one. We're going to have reversals and continuations in the market, and you're all aware of this already. You see that when there is a trend, it tends to continue for a certain period of time. Even when it does a small retracement, it will still continue to head upward. So you should always be aware that what's going up has a high likelihood of continuing to go up. So you shouldn't be trading against the trend. Same way if it's going down, there's a high probability that it's going to keep on going down. Don't trade against the trend. Eventually, all trends end. So those continuations will sooner or later run out of steam, You're going to have a reversal. You also need to be aware of those. If you see a reversal happening, but you ignore it and try to continue trading the old trend that is no longer valid, you're also going to have issues. All this leads us into what I'm just going to call, for the sake of argument, bad analysis. If you're not taking the intelligence that the charts are giving you at any given time and you're ignoring reversals or you're ignoring continuations, then really that is an example of bad analysis on your part, or I don't know, you're just not reading the right signals. Maybe you're doing the analysis right, but you lack some of that savvy on how to read the charts. Either way, there are ways to protect ourselves against this, and usually I'm going to be doing this. Even if I take a wrong trade, I'm going to have a stop loss that prevents it from wiping out my account in case I am very, very wrong. And we'll get to some of that in some of the later sections as well on how this can affect you. The other thing is lack of confidence. Lack of confidence, of course, is going to hinder you when you're taking trades. You're going to hesitate before jumping into trades because, oh, I lost the last time I did this. Should I really take this trade? And before you know it, that trade that you analyzed the right way is making 200 pips, but you never took the trade. That is a clear example of lack of confidence. And of course, the flip side of that coin is going to be overconfidence. You made 5 trades in a row that made you a bundle of money. You think you're invincible, and you're going to take a trade that you shouldn't have taken, and suddenly that one trade is going to wipe out your gains from the 5 trades that you did make money on, and probably even more than that money. So overconfidence has the potential to kill your account. All of these are things that we should already know and be protecting against to some degree, but many times we tend to either ignore them or just we're not aware that we have this working against us until it's too late. On the account side, we can also be over leveraging, and this is when we are using up more margin than our rules should allow. Even if the broker gives me the ability to trade at 1 to 1,000 margin, that doesn't mean I have to do it. So when you make up your account trading rules, we're going to be setting up some very strict conditions on how much you can safely trade. Overtrading is another aspect that can hurt your account, and this is when we're just taking on too many trades. Maybe we're not over leveraging per se, but we're taking so many trades that either the winners end up balancing out with the losers, and we ended up working 40 hours that week in trading, and at the end of it, we only have $5 gain or maybe $5 loss to show for it. That was a very bad use of your time. So we need to also get better at looking at what are the valid trades and ignoring the noise. A lot of the signals the market gives at any given time are noise, and we filter those out via several techniques, and I'm not going to go into the nitty-gritty details here. I just want you to be aware that that may be happening. But in a nutshell, whatever strategy you're using to pick the trades that you're going to enter, it has to have enough conditions that you filter out a lot of that noise, and you only take the trades that give you the highest possibility of success. And even the master traders, the elite traders, the superhero traders are sometimes guilty of this overtrading. And it doesn't come on its own. And part of it is overconfidence. Part of it is that we start thinking that we're better than the market. The market is doing what we want instead of what the market wants, and so on and so forth. And we try to increase our profits at a faster rate than is safe. So overtrading is something you also have to be aware of. And if you find yourself doing it, recognize it and stop. Getting emotional. And this brings us right back to the whole psychology and Callum's area of expertise. If we start getting emotional when we're trading, the market is going to have the advantage. Anybody who's been in an argument or has been in enough arguments, I should say, realizes that whoever gets angry first basically has lost the argument. Once you're screaming at somebody and using insults instead of rational arguments, you've basically said, I have lost this argument. You may end up winning the fight if you're bigger, badder, hit harder, scream louder, or whatever. You may even end up winning the fight, but you have lost the argument. So keep your emotions in check. There are several techniques to do that, and Callum is doing a really fine job at giving you these strategies, these techniques, and these methods to curb your emotions. There is a place for emotions in the market, but you should have them under control. I like to go back. I read a lot of religious scriptures and whatnot from different religions around the world. And one of my favorites has always been the Bhagavad Gita. That's the story of Krishna from the Hindu scriptures. And he is a charioteer, and he's guiding a chariot that is carrying Arjuna, the general on whose side Krishna was fighting. And that chariot has 5 horses. And Krishna, when he's trying to teach Arjuna, he's telling him that these 5 horses are like the senses. They are trying to run out of control. And your mind is the chariot master. It's your job to keep your senses and hence your emotions under control at all times. When you use them in your favor, they're like those 5 horses leading the chariot in a single direction at full speed, all in coordination, all striving for the same goal. But if you don't have a tight hand on the reins, then each horse is going to go its own way. The chariot is going to be overturned, and you're going to fly out and hit your head against a rock. And when I read that at a very tender age, I think I read that back when I was 14 or 15 years old, when I started reading some of the Hindu Vedas, that always struck me as how very apt it was to everything in life. You have to have control of yourself before you can control anything outside of yourself. So that is the emotional aspect. You have to be aware of your emotions, and you have to control them. Communications. And by communications, I mean electronic communications. All or virtually all the trading we do today relies on us being able to place trades over our devices, over the internet. That could be from a computer, from a tablet, from a phone. If those communications aren't working either on my end or on the broker's end, then we have a problem. I won't be able to place any trades. More importantly, if I'm in a trade that I want to get out of, I probably won't have a way to close that. So I should always have some plan B or plan C that allows me to connect to my broker, to connect to my sources of information, to connect anywhere I need to in order to get my trading done. Even if, I lose power at home and then I have no internet, if my phone dies, I run out of battery, whatever, there has to be some sort of plan B. In a pinch, almost every broker worth their salt has a trading desk with a phone number where you can call and say, hey, I'm Andy, account number 8567509. Actually, it's 8675309. That's what the song says, 8675309. And I have an open trade on the USD Swiss. I would like to close it immediately, please and thank you. They will ask you a couple of questions to verify that you are indeed who you say you are, and they will close that trade out for you. But if you don't have that phone number handy or you don't know how to get a hold of them, then you're dead in the water until your communications problems are resolved. And by that time, you may be deep in the hole. Another aspect of the known is shady brokers. You need to know who your broker is. You can't just click on an ad on Google or on Facebook or whatever that says Slim Shady Brokers Limited. We're going to give you 1 to 1 million leverage. Oh my God, that means I can make $1 million in like 5 seconds. Excellent. And I send them $10,000 to fund my account. And the next thing I know, whether I made money with them or lost money, they really don't exist. I have no way of withdrawing my money, even if I won the millions I thought I was going to win. And I have seen this personally happen to more than one trader. By the time I've told them, hey, listen, I've never heard of Acme Trading. Are you sure those guys are legit? Yeah, I've been trading with them for a year. Well, have you ever withdrawn money from them? No, not yet. But okay, that's not good, is it? So why don't you try to withdraw a few funds there and see what happens? And they reach out to me the next day, and they tell me, listen, nobody's answering my emails. They're not picking up the phone. I've tried to withdraw $1,000 of the 10,000 I have in my account, and I'm not getting any response. Well, whose fault is that? Shame on them, of course. They're shady operators. They're basically crooks. But did you really expect anything different from a company no one's heard of on an ad that you clicked on Facebook without doing any research? So you guys need to research who your brokers are. If you're using somebody solid, well-known, like, again, I'm going to give an example from my own life. I use TD Ameritrade almost exclusively. They're one of the largest banks in the United States. If those guys go under, then there's bigger problems than my money disappearing from my account. That means that probably the entire economy of the U.S. just went belly up, and there's civil war across the country and people shooting out windows. So the least of my concerns at that point are going to be that TD Ameritrade isn't returning my calls. But in the regular scheme of things, I shouldn't be worried about where my money is. That should be a source of comfort for me instead of keeping me up at night. And last on my list here is government regulations. And there are many countries around the world where Forex trading is actually illegal. There's a law that says you cannot trade Forex. And if you do, you have to pay a fine or you're going to go to jail or whatever. Don't come to me later on and say, listen, I got the police at my door because this stuff you're teaching me about Forex trading is actually illegal here. You need to know about this. You need to be aware of what your local conditions are, any government regulations to that effect. If you need to be paying taxes, then pay your taxes, and so on and so forth. That is not something that we as a company, as Special Effects Academy, are equipped to tell you, because you guys can be in any of like 170 countries out there, each of them with their own laws. So you need to know what your trading environment is. If you live in a place like, and I'm going to just shoot from my hip here. If you live in India, Forex trading is illegal to you, except you can trade any Indian rupee crosses. You can trade the rupee against the euro, the rupee against the dollar, the rupee against the yen. Those are legally allowed. And very recently, in the last year or so, they're now allowing you to trade the euro against the dollar, the pound against the dollar, and the yen against the dollar. Any other trade, the pound against the Canadian, for example, is illegal. You can go to jail for that. So you need to know what your conditions are. And this is all known stuff. This is stuff you can find out with a simple Google search. So there is no excuse for somebody turning up a week from now and saying, I did not know. That is all on you. So make sure you're aware of everything that has to do with your business as traders, and make sure you follow all the rules. Even if trading is illegal in your country, there are ways around that without breaking the law. You can set up a company in another country that does allow Forex trading, and trade as a company out of that different country. Again, providing that it's legal for you as an Indian, I'm going to keep on using the example, to set up a company in the UK. If it's legal for you to do so, then there is nothing preventing you from doing that. Then any profits from that business you can repatriate into India once you pay the proper taxes and you haven't broken any law. But all that implies that you do know what the laws are and you know your way both around them as well as following them to keep yourself safe. And that's going to be the end of my examples of known risk that you need to be aware of. And now I'm going to flip into a much longer section that is the unknown risk. By definition, the unknown is what we don't know. What you don't know can always hurt you. The unknown is also a bit more difficult to defend against, again, by its very nature, but it's not impossible. And I'm going to give you some examples of the unknown, black swans, and we're going to cover black swans in detail in the next couple of slides, so I'm not going to go into a lot of detail here. Unexpected announcements, anything that comes out in the news that was not expected. Could be anything as simple as 3 years ago, the Swiss government decided to unpeg the Swiss currency from the euro. Before that day, it was a certain amount of Swiss francs would buy you a euro, and that rate was set by the government. So if you were trading the Swiss franc and the euro went up, the Swiss franc went up. If the euro went down, the Swiss franc went down. They moved in tandem. It was very predictable. And a lot of people would trade the Swiss franc as an alternative to the euro. If they thought they could get a better spread or a better rate on the franc than they could on the euro, then a euro USD trade would be placed instead as a USD Swiss trade. When the Swiss government unpegged the Swiss from the euro, the Swiss franc appreciated against all the other currencies by about 2,000 pips in a matter of seconds. The euro didn't move, the dollar didn't move. It was the Swiss franc on its own that suddenly strengthened by about 20%. That is a huge amount for a currency. When we're talking about trying to make 1 cent, this thing moved 20 cents in split seconds. Took everybody by surprise, bankrupted brokers, bankrupted traders, even traders that were on the right side of that trade, that were trading towards Swiss strength. They found out the next day that, yes, they had made $1 million quite unexpectedly, but no, they would never see that $1 million because the broker had gone out of business as a result of the massive losses incurred when the Swiss franc strengthened. A lot of brokers are taking the opposite sides of your trade. When you sell the euro USD, instead of that trade going out to the open market, the broker says, I'll take that bet. I think it's going to go the other way. So come here, Andy, let's see your money. I'll take the opposite side of that bet. So if I end up winning and the euro USD moves in my direction, it's the broker's money, the broker's dollar. Remember I said that Forex is a zero-sum game? That dollar that I won, or the $1,000 that I won, are coming straight out of the broker's pockets. Does the broker normally care? Nope, because in the same way that I won money, they are winning money from other traders that did the opposite. So it sort of balances out, and the house does have some advantage because they get the spread and the commission. So sometimes they end up making a lot of money out of taking the opposite side of your trade. But when something like the Swiss situation, unpegging from the euro, happens, then the broker may be caught basically over leveraged and over trading. So brokers can be guilty of the same things we saw in the known risk. They didn't mitigate that risk, and suddenly they're millions of dollars in the hole. When that happens, the broker packs their bags and moves to another country, and good luck recovering your money. So these unexpected announcements can have dire consequences. We also have flash crashes. That happens when somebody either pushes the wrong button, and by somebody I mean somebody big, like an institutional investor, let's say George Soros. He's fat thumb finger today, and he presses, instead of selling 200 lots, he sells 2 million lots. And before you know it, that currency pair went through the roof because of the volume that this mistaken trade created. That has happened quite a number of times. It never lasts. We saw the last flash crash happening in October of 2016 when the pound basically crashed to the bottom of the charts because somebody in Asia, it's not clear, they never quite came out and confirmed what had caused it, but it was either a fat-fingered trader, a human, that put in the wrong order, or a computer glitch made some trades suddenly enter the market, and that set off a domino effect. 100 trades got placed, and they drove the price of the pound dollar down by 100 pips. That triggered sell orders or stop losses on 1,000 other traders' machines, which then also sold the pound dollar, which in turn triggered another 10,000 machines to also sell the pound dollar at an even lower price. And that continued cascading and growing, much like a snowball can turn into an avalanche if you drop it in the right spot and it starts picking up snow. That's what happened in October of 2016, and the pound fell after already having fallen quite a lot. This was just a few months after Brexit. It fell another 1,000 or so pips in a matter of seconds. And then just as quickly, it reversed in another few seconds and went back to where it had been before the flash crash. Did that help you if you were on the wrong side of that? Nope. The broker had already closed you out with 1,000 pips of loss, and the recovery had no effect on you because you were no longer in that trade. And you have no way to know when a flash crash is coming. That is why it is an example of the unknown. We know what a flash crash is. We don't know when it's going to happen. It's an unknown. Regional or global conflicts. If North Korea shoots a nuclear missile right now towards Japan, we have no way of predicting that. It's just going to happen. And when it happens, you will see that the Japanese yen is going to do something. I don't know what it's going to do, but trust me, it's going to do something. And you cannot protect yourself against that normally because it is another unknown. Political upsets. Recently, the president of South Africa was indicted on, I don't even know what the guy did, illicit enrichment or some such peccadillo for a politician. But he was ousted from power. He's no longer the president. The South African rand, their currency, took a severe hit at the time. And it's not the first time this has happened. That's a country that has a lot of political unrest. And do you know when the next scandal is going to break out? No clue. Is there going to be a next scandal? Hell yeah. You can bank on it. The only thing you don't know is when it is going to happen. So that's another unknown. Natural disasters. If you have a tsunami hitting right now in, I don't know, Indonesia, Japan, Hawaii, that will cause massive movements in the Forex market and probably every other market that has something to do with the affected area. Again, something you cannot predict. You only find out when it actually happens. Mass terror attacks. If right now 27 Islamic terrorists fly 4 airplanes into buildings in New York or into the Pentagon or into a field in Pennsylvania, which would have sounded ridiculous 20 years ago. If I had suggested that was going to happen, I would have been laughed out of the room. Now, well, we know it did happen. And when it happened, the stock markets crashed, the dollar crashed, and 5 minutes before it happened, nobody could have predicted it except the 20 whatever terrorists that had hijacked the airplanes. They were the only guys who knew, and trust me, they were not trading at the time. Next on our list is extraterrestrial invasion. And now I'm being ridiculous because that's what an unknown is. It's something that sounds ridiculous until it happens. I'm not saying that the extraterrestrials are going to invade. I'm just giving you that as a very ridiculous example, just as ridiculous as 20 terrorists flying airplanes into the World Trade Center and the Pentagon would have been ridiculous 20 years ago. A solar flare aimed at Earth. That could very well happen. It's actually less ridiculous than the extraterrestrial invasion. If we get a solar flare aimed at the Earth, it will literally cook whatever area it's going to hit. And of course, we're a very small target in the grand scheme of things, but it certainly could happen. And depending on where it hits, it's going to be either a dire catastrophe or an extermination catastrophe. And no way of knowing until it happens. And last but not least, the second coming. If Jesus comes back, trust me, it's going to affect the markets. I'm not saying he's going to come back, but it is an example of the unknown. And really, you need to continue filling this list because the unknown, by definition, is something that I'm probably missing. I probably have not taken it into account. If you can build some scenarios in your mind, by all means do so. And just as I try to put in ridiculous stuff here, nothing is too ridiculous. If there's even a 0.0001% of it happening, then trust me, given enough time, it's probably going to happen. Now I'm going to dig a little bit deeper into Black Swan. You've heard me use the term before, but I've probably never explained it. The phrase Black Swan derives from a Latin expression. Its first known occurrence is from a Roman poet by the name of Juvenal that lived in the 2nd century after Christ. And he characterized something in one of his writings as being rara avis in terris nigroque similima signo. That's Latin, my friends. And it means a rare bird in the lands and very much like a black swan. Why did he use the term black swan? Because until then, and for millennia afterwards, no one had ever seen a black swan. It was presumed that a black swan did not exist, could not exist. And we went gleefully along believing that it couldn't exist, never would exist, until European explorers went to Australia. I forget if that was the 18th century, probably around the 18th century. So call it the 1700s or early 1800s. We've got the first Europeans going over and exploring Australia. Lo and behold, what did they find? Black swans are actually pretty common in Australia. They are more common than white swans, as far as I know. So black swans now existed. So all these metaphors and the popular sayings as likely as a black swan and everything else was suddenly proven wrong. The importance of the metaphor, the black swan, lies in its analogy to the fragility of any system of thought. Just when you think you can't be wrong, reality slaps you in the face. A set of conclusions can be potentially undone once any of its fundamental postulates is disproved. This is a statement from logic. If you have an argument and you know that you can't be wrong because you know for a fact that the dollar can never drop 50% in a single day, well, you're right today, you're right tomorrow, you're right for a week, and then suddenly it happens. It doesn't matter if it happens only once. Once it happens, you're not only wrong, but you probably wiped out your account. And that is why we call these unexpected unknowns black swans, because that is the perfect example of something that couldn't possibly be until we discovered that it actually could. Moving on to my second slide on black swans. So a black swan in the market is going to be an unknown unknown. We call that a black swan event. No one's expecting them. And when they happen, the market reacts catastrophically. Why does it react catastrophically? Because everybody thought it could never happen. And once they're proven wrong, panic ensues. You get everybody getting emotional and selling out of fear or buying out of greed or whatever it is they're doing once they're faced with that black swan that upends all their mental framework. And the only thing we can know about a black swan is that they will happen and that they do happen with some regularity. But we don't know what they're going to be or when they're going to happen. So we just have to be prepared for the unknown slapping us in the face every now and then. And of course, they carry huge risk because if the market is going to be reacting catastrophically, That means that any trade I'm in can go in either direction. It can go in my favor or it can go against me by thousands of pips in a matter of seconds. There is no way to protect your account from that happening. You can tell me, well, Andy, I have a stop loss of 50 pips, so as soon as that pair moves 50 pips against me, I'm going to get out. That's my maximum loss. Well, no, because when a black swan happens, it happens so fast that even the computers can't keep up. When your 50 pip loss, stop loss gets hit, you're not the only one that put a stop loss at 50 pips or at 100 pips or wherever. There's millions of other trades out there with similar stop losses, and all of them, millions of different trades are being triggered at the exact same instant. All those trades are going to try to flow into the computers that govern the trading, and those computers are going to explode, not literally, but basically they're going to crash. Your trading systems are going to be down for hours. Meanwhile, your stop loss was actually never executed because the trade never got to a computer that was operating. So your stop loss is somewhere in limbo, trying to get there and not managing it. The system comes back after 3 hours. By that time, you're not 50 pips in the hole, you're 2,000 pips in the hole. It's just blown through your stop loss. And then when the computers recover, they do see that you blew through your stop loss and they take you out. But they don't take you out at a 50 pip loss. They take you out at the 2,000 pips. And if that 2,000 pips represented 10 times the equity in your account, not only is your entire account gone, but you also owe $40,000 to the broker, in theory. My point in that is good luck collecting that, because I didn't tell you to blow past my stop loss. But be aware that you will be carrying a negative balance of $40,000 after the event. But more importantly, let's say that my account had $200,000 in it. So I had more than enough money to cover my trade and even more than enough money to cover the $40,000 loss. The broker is going to take those $40,000. They're not going to care that it blew past the stop loss that should have been triggered. They're just going to say your trade is $40,000 in the red and you had $200,000 in your account. Now you have $160,000 and thank you very much for your business, my friend. So we cannot ignore the impact of these black swans. You're either going to end up highly negative, or you're going to end up losing a significant chunk of your account if you had enough money, or you may end up highly positive. You may have those $40,000 in your favor. But when you go and check if the broker is willing to give them to you, you may find out that the broker is no longer there, because you were not the only one who won $40,000. They're at a loss of $40 million combined, and they just decided the safer bet is to pack their bags and move to Cyprus. And good luck finding them there. So I hope I've managed to scare you enough with the black swans. They're beautiful creatures, though. If you look them up on Google, these Australian black swans are majestic animals, but they're scary in the market. And now that I've frightened you enough with all the bugaboos that are out there, we're going to look at some ways of equity protection. And these are designed not just to protect you from the known risk, but also from the unknowns, from the black swans, from the unknown unknowns. Again, never 100%, but let's see how far we can get. So, how to protect your equity. Section 3 of this presentation. Never keep all your eggs in the same basket. You've all heard that saying, or variation thereof. What does that mean? Remember when I told you that if I had $200,000 in my account and I'm suddenly losing $40,000 because of a black swan, then the broker would simply take the $40,000 and leave me with $160,000? Well, don't have $200,000 in your account. That's the simplest way to protect yourself from that scenario. Instead of having a $200,000 account, have 20 $10,000 accounts with different brokers. Supposing that one of them went negative by $40,000, well, abandon that account. Good luck, set it free, wish it well. You still have 19 accounts with $10,000 in each one of them. So while it's not fun to lose 5% of your account in one day, that would be the 10,000 that was in this account that got blown up, you at least still have the bulk of your money, 95% of it, available to continue trading. Of course, if you only have $2,000 to your name, you're not going to be opening 20 $100 accounts. That would be silly. The cost alone of maintaining the accounts would probably end up costing you a significant chunk of the $2,000. So these are problems of the rich and successful traders. When you get to that point where you have the $200,000, don't forget what I said. That's when it becomes time. In fact, if you have $20,000, I would recommend that you split that into 4 $5,000 accounts, and so on. So your equity management is going to evolve as your money grows. But the thing that you need to remember is never keep all your eggs in the same basket. That should be enough of a mnemonic for you to remember what I just said. Next, never be all in. If any of you have played poker, you know what all in means. It means that I have a brilliant hand, I have 4 aces and a king in my hand. All the other people are showing face cards that the highest one is a 10. So I'm pretty sure I'm going to win. And I just grab all my chips and push them to the middle of the table and say, I'm all in. And I wait for the suckers to go all in as well, so I can pick up their money for basically nothing. And then when I'm pretty certain that I've won, and I'm showing my cards and I'm reaching over to drag all the chips into my corner, the guy in front of me comes out with a royal flush and beats my poker of aces. And he's the one that gets to grab all the chips and move them over to his side of the table. Meanwhile, I'm left with not a chip to my name. So not only did I lose that hand, but I also lost the ability to continue playing and trying to recover some of the money I just lost. So never be all in. What does that mean in the Forex market? If I believe that the US dollar is rising, and that is a perfectly fine belief for you to have, and you may be even right, but should you trade every single US dollar pair to the exclusion of everything else? Are you going to put all your trading money, all your equity into trading the Euro USD, the USD JPY, the Aussie USD, the Kiwi dollar, the USD Canadian, the USD Swiss, and so on and so forth? What if you're wrong? What if instead of the dollar getting stronger, it gets weaker? Suddenly, every single trade you have open is going to go negative because you put all your money on one horse, the US dollar. You went all in. So never be all in. If you're going to trade a certain idea that you have that the dollar is going to go up, trade 2 or 3 USD pairs. And more importantly, if you followed the first instruction of never keeping all your eggs in the same basket, trade those 3 USD pairs on just one account. If you blow that account up, then that's the risk of playing the game. But don't have open USD trades on every single one of your 20 accounts or your 5 accounts, because if they all go against you, God forbid, a black swan event happens that affects the US dollar, it could wipe out every single one of your accounts. The fact that you had 20 separate accounts is no longer going to protect you because you injected risk by placing the money of all your accounts into a single pair or a single currency based on a belief that you had, and then the black swan comes along and slaps you in the face. So that's the second recommendation. Never be all in. Next, incorporate. What does that mean? When you get to the point where you have those $200,000 or $50,000, stop trading as Andy Pedraza. Andy Pedraza is a human that pays a very high tax rate because he is an individual taxpayer. As an individual taxpayer, In the United States, this may not necessarily apply to every single country out there, but an individual taxpayer pays the highest amount of tax. A corporation, a company, pays a smaller amount of tax. And more importantly, they get to write off a bunch of expenses. If they pay rent on a building, that's an expense and they take it out of their taxes. If they own the building, the depreciation, which isn't money coming out of anybody's pocket, it's just a fiction, an accounting fiction that says that the building that was worth $1 million at the start of the year is magically now worth only $900,000. So I lost $100,000. Did they come out of my pocket? Nope. The accountant simply determined that the building is worth 10% less this year. But the important thing about this accounting fiction is I get to write off those $100,000 as if they had been a loss, as if somebody had broken into my bank account and stolen $100,000. So if I had to pay $100,000 in tax, now suddenly I don't have to pay anything. And instead of those $100,000 disappearing, they do slide right into my pocket. When they slide into my pocket, however, I do end up paying taxes on them because now they slid into the pocket of an individual taxpayer. But that's a separate argument. There's ways around that because you can have your company own your house, own your car, pay you a salary, pay your health benefits, and do a bunch of other stuff that are all legal expenses for a company and can get written off on the company's taxes. And by the end of the day, you can pay yourself the salary of $1 a year like Warren Buffett does, but have all your expenses taken care of by your company. This is perfectly legal. It's the way the rich get richer because they know how to work the rules in their favor. I am sorry. So if you get to the point where you're making that amount of money or you have that much amount of money to trade, it would be in your best interest to set up a company and no longer trade as Andy Pedraza, but trade as, I don't know, Special Effects Academy. And then Special Effects Academy can have all the write-offs. Andy Pedraza can get a salary of $1, but his house is owned by Special Effects Academy. His car is a company car owned by Special Effects Academy. The only thing Andy Pedraza needs to worry about is keeping the power on in his house and buying groceries every now and then. Everything else is taken care of. Andy Pedraza wants to go to vacation in Hawaii. Well, the board of directors meeting is scheduled in Hawaii at the same time, and all the directors meet in Hawaii. The company pays for the trip, the hotel, everything else. They meet for a half hour, sign the minutes, and the rest of the week that Andy and his board of directors are in Hawaii, the company's paying for it, and that is a legitimate business expense for the company, which gets taken out of the taxes. So there's many ways of doing it legally and very smart and to your benefit. So when you get to that point, research it. Ask us how to go about doing it. We'll be happy to give you some recommendations. Again, your mileage is going to vary depending where you live, what country you're a citizen of, and what your tax situation is. But in general, when we're talking vast amounts of money, doing it as a company is going to give you many, many advantages as opposed to doing it as a person. Next on our list for protecting equity, never knowingly risk more than a certain percentage of your funds on a single idea. This goes back to the never be all in. So they're pretty much sort of the same thing, but I wanted to re-stress it here so you don't forget what I'm talking about. So never bet everything on a sure thing. Either spread your risk around by taking other trades that do not involve that single brilliant idea that you had, or just simply don't trade all your money on that one idea, the don't be all in portion of it. Vet your broker. We already covered that in an earlier slide. I made that recommendation, so you need to be aware that you have to know who your broker is and how they are treating you, where they're set up, and that they actually exist as a reputable entity. And last but not least, always have a plan B. and a plan C, and a plan D. Everything I mentioned before on how to protect equity is different plans that you have. Well, if this happens, then I'm protected here. But if that happens, then I'm protected over here in this case. And if that other third thing happens, then this is protecting me. There's going to be a million things that can attack you. And you're going to be protected against 95% of them. That will still leave you with a 5% risk. That's okay. We can never completely eliminate risk, but we can certainly eliminate 95% of it. And which is preferable, to be totally unprotected or to be 95% protected? Achilles from Greek myth had his one weak spot on his ankle. That was the only spot that was not protected. He lived for many good years and won many battles and was invulnerable until somebody finally shot him in that one spot. Had he not had that 95% protection, he would have been dead years earlier. So that 95% protection still kept him alive until finally his one weakness was discovered. And again, he was betrayed. Under normal circumstances, he would still be with us, fighting somewhere. But somebody betrayed him and told his enemies that his heel was the weak spot, and that if they fired a poison arrow on that one spot, that would kill him. And that was his black swan. The fact that his ankle, his heel was unprotected, and the fact that somebody else knew about it and betrayed him. I think he was betrayed by his mother, by the way. I've never trusted my mother after I heard that story, but I digress. Let me continue on with the presentation. So, I've already said this before, protection is never going to be 100%. That is unachievable. Don't even try. But that doesn't mean that you can't do everything else in your power to protect yourself as much as you can. So while you can never achieve the 100% equity protection no matter what you do, you have to take steps to protect it from all but the most extreme, and by that I mean unknown or unpredictable situations. This is going to take planning, and your planning is going to depend on your situation. We covered some of that already. You're not going to incorporate and set up a company if you have $2,000 to your name. You're not going to open 10 trading accounts if you have $1,000 to your name. So your situation is going to dictate what your plan is going to look like. But more importantly, if you have $1,000 today, that doesn't mean you're not going to have $2,000 in a year, $200,000 in a year. So your situation is going to change. And as it changes, you're going to need to revise and review and change your equity management and protection plans. The recommendation is that you do this at least yearly. So review your equity management and protection plans yearly at the very least. Make it here in the U.S., when we change our clock, which is going to be happening this Sunday, there is a long-standing recommendation that's become a custom that we check the batteries on our smoke detectors. So we've become ingrained. It's become second nature. It's become a habit. Every time the clock changes, I go and look at my smoke detectors and I test them and make sure the batteries are okay, that they're still working. Would I normally do that if it hadn't been drilled into us as children? The clock changes. Check the smoke detectors. We've got commercials on TV. We've got fire prevention campaigns going on with the fire departments and all that stuff that just makes it a habit. Same thing. Set something up every year on your birthday, on Christmas, on whatever day of the year, maybe when the clock changes, right after you check your smoke detector batteries. Take out your equity management and protection plans, review them, and make sure that they still apply to your situation on that day. If they don't apply, of course, change them so you feel comfortable with them again, and then do that yearly. If you happen to have a significant event happening, like you won the lotto tomorrow, then, of course, sometime next week, take time out of your gloating and review your plan, because it will no longer fit for a person that has just won $50 million. So you're going to need to review that as well if your situation changes, even if a year has not gone by since your last review. Coming back to black swans can be incredible opportunities. In one of our earlier sessions, we mentioned fishing in troubled waters. Fishing in troubled waters is a very good thing sometimes. When everyone else is panicking, you can make a killing. If everybody else is selling, things normally tend to go too far. They drive the price down too low. And if you're paying attention and you're keeping a calm mind, you can say, okay, that's too low, and you can start buying. And when the inevitable retracement or recalibration of the market happens, suddenly you're sitting on a pile of money that you did not expect to have under normal circumstances. So you have to be ready anytime there's a black swan, regardless of whether you were hurt by it or not. You have to be aware that the market always, I'm not going to say always because then I'd be guilty of the black swan fallacy as well, almost always overreacts. It should drop 1,000 pounds, 1,000 pips. Instead, it drops 2,000 pips. Well, when you see it drop down that low, you buy it. It's like buying at a discount. Then a week later, it went back to where it was, and suddenly you made 1,000 pips or 2,000 pips without any significant risk. So the moral of the story is that when everyone else is panicking, you can make a killing. The two important things in the uncertain times is that you have equity freely available. If you don't have money to trade, you can't trade. And that you have a calm mind. There is a famous sword master in Japanese history back in the 16th century called Miyamoto Musashi. He wrote one of the first treatises on sword fighting. And one of his recommendations was to be calm in times of trouble and be troubled in times of calm. Never let your enemy see your inner mind. If your outside is calm, your inside should be troubled. If your outside is troubled, your inside should be calm. I paraphrased him here when I said be calm in times of trouble, be troubled in times of calm, but that is the basic idea behind what he said. And it definitely applies to trading. Our fourth section is going to be trade protection. So this prior section focused on keeping your general money safe, your equity, money, trading capital. They're all synonyms for the same thing. In trade protection, we're going to look to keep every single trade that you take. It has to be set up to protect itself. So it has to be its own little microcosm. But more importantly, it should align with your general equity management rules. So it should not only protect itself, but it should not place your equity at any higher risk than what you've allowed based on your trading rules. How are you going to protect the trade? You're going to do proper analysis. And we touched on this earlier in that if you don't know when a reversal is coming, when a continuation is coming, then you're not doing proper analysis. You need to get good at your game. You need to have a proper entry. We don't enter a trade just because it feels like it right now. We have a strategy. That strategy is going to dictate when I can take a trade. That trade is going to use the proper trading lot size. It goes back to not over leveraging my account and not putting myself in an all-in situation or putting all my money in a single big idea. So I'm going to be using a trading lot size that matches my equity management rules and my trading rules. If I'm able to trade 5 full lots based on my account size, and am I going to trade 5 full lots? Heck no. I may be trading at a half a lot or maybe a quarter of a lot. I would never be trading everything I have on a single trade. So you have to know beforehand what your trading lot size is going to be. You need to have adequate stop losses specific to the trade itself and that align with your equity management. And I'm going to explain this one a little bit further because it warrants it. If I enter a trade on the Euro USD with a proper trading lot size based on proper analysis, with a proper entry based on my strategy, I need to determine where I'm going to place that stop loss. Most of the time, my strategy is going to tell me, well, you have to place the stop loss below the most recent low. All righty. Let's take a look at that. That would be 80 pips. If 80 pips is more than I'm willing to risk based on my rules, then I have two choices. I can either not take that trade because it would violate my trading rules, or I can trade a smaller lot size to bring it in line with my risk management. If I was trading half a lot, then I go down to trading a quarter of a lot. And now those 80 pips are the equivalent of 40 pips in my normal trading. And that would bring me in line with my rules, which again must also be aligned with my general equity management rules. I have to have a proper exit, again, usually dictated by my strategy. My strategy will tell me, well, if I'm risking 80 pips, then I'm going to be looking for at least 80 pips. I'm not going to be risking 80 to look for 20. That would be bad trade and equity management. So my strategy is going to dictate what I'm looking for. And as my last little bit of wisdom in how to protect the trade, we have to have proper trade management. Cut losses short. That's going to be handled by my stop loss. But more importantly, let winners run. And you guys that have been trading with me for a while have seen me do this. I will start adjusting my stop to protect my profit. At some point, I can no longer lose, well, barring a black swan that makes it crash 1,000 pips in a few seconds. But barring a black swan event, the trade becomes one that is impossible for me to lose money. Worst case scenario, I get taken out with a smaller profit than I had at any given time, but still a profit. But more importantly, if I see that a trade is moving in my favor and is showing enough strength to blow past my limit, my intended profit taking, I will move that limit. I'll move it further away to give the trade enough room to grow. So I'm going to cut my losses short and let my winners run. This week, you guys saw me do that with one specific trade, the USD Swiss. First off, I moved my stop loss to start following it as it climbed. But more importantly, I moved my limits. Initially, I was looking for 100 pips of profit out of that trade. When I saw that it was at 90 pips of profit and not showing signs of stopping, I moved my stop loss to protect the profits, and I moved my limit, my take profit, I moved it further away. I ended up getting about 130 pips out of that trade. So not a fantastic amount, but certainly 30 pips better than had I let it take me out at the 100 pip target that I initially had. So when you're managing your trades, you need to be aware of the need to cut your losses short. The stop will handle it. And more importantly, let your winners run. These winners that you let run are going to provide the bulk of your profits and are going to swallow up any losses that you take along the way, because not every trade is going to be a winner. I try to repeat that to you guys as often as I can. You are going to be wrong. You can do the perfect analysis and you will still get it wrong, because only the market is always right. You will never be always right. So we go for trades with better odds, and we let our profits go as deep as they want, and we limit our losses. That is the secret to managing a trade, and is part of the protection of a trade. And that is the end of the 4 sections. My final section is really a what are the next steps? So what can you do to protect yourself from risk? First of all, avail yourselves of our offer to help you capture your trading plan. That is a key part of the Elite Trader program. It's included in what you already paid. We are starting to get to the point where we're going to be drafting those initial trading plans with you. We're going to be helping you do that. You'll be drafting them. We'll be assisting you. But avail yourselves of that offer. Don't go at it alone, because you're smart. All of you are brilliant and geniuses, but that only goes so far. Callum and I have the experience. We've already made the mistakes, and we've seen others make the mistakes. So take advantage of that well of knowledge so that we can show you things that you may not have considered, and that will definitely affect your plan and make it stronger, make it better. Your plan is going to be customized. It is going to be individual to you. If we had a generic plan that worked for everybody, we would have already emailed it to you. Oh yeah, do A, B, C, D, and E, and that's it. Go along and play. It doesn't work that way. Your trading plan is going to be specific to you. The trading plan that works for you will not work for me. My trading plan will not work for you either. So we'll build one that's customized to your situation and is going to factor in everything you need to protect yourself, your equity, and your individual trades. You will come out of that with a set of rules that's designed to let you trade safely and profitably. And last but not least, I'm going to show you what our main focus is, and you've seen this from the beginning. We are focusing on several foundational bedrock aspects, pillars of proper trading. Trading psychology is by far the most important one. Every successful trade starts in your head. If you don't have your head screwed on right, you are not going to succeed. Then we have trading skills, which lets you know when and how to trade, but always based on that proper trading psychology. In the middle of them, we have your equity management, your trading plan. This is going to combine the first two. Your trading psychology and your trading skills are all going to be filtered. They're going to be distilled. They're going to be concentrated, and they're going to result in a proper equity management and trading plan. That is what's going to get you to the 100% of your abilities, of your potential. For your success to safely, reliably, and consistently trade. And what that means is success. And at the bottom of the slide, I have the success bar, which far exceeds the 100% of all the other bars that we're seeing on the screen. This is synergy. The sum of the parts is greater, the whole is greater than the sum of the parts. That is the definition of synergy. So this is where it all comes together. Trading psychology, equity management, trading skills, they all combine to give you something that violates the rules of math, but does not violate the rules of synergy. It gives you something that is more than 100%. It guarantees your success. And that is the end of my little introduction to risk. I'll now open up the floor to any questions, comments, or concerns, and also to thank you for being a part of the presentation. So if you have any questions, guys, now is the time. Otherwise, I will suspend the recording very shortly, and that will be a wrap. Again, thank you very much for participating, and I'll get this recording out as soon as humanly possible so that you guys can review it. This is one of those that you're going to want to review, and you're even going to want to look up some of the terms that are used along the way and familiarize yourself with them. So thank you. That is all I got for today.